Coming to the next set of calculations on the portfolio, on the same example continued. See, now what we have seen here is there are so many combinations of this risky portfolio. Basically, it's a risky portfolio, right? Risky in sense there is some standard deviation existing. In no combination, it is becoming zero. Let's say the securities have a correlation of zero. Because see, I cannot change that number. That number is purely coming from reality. Here just to demonstrate I am changing the correlation. But in reality it's a fixed number between two securities which is to be computed looking at whether A has gone up when B has gone up or A has gone down when B has gone up. Depending on those kind of scenarios, the correlation is a one standard value. Here I am just altering it manually because I wanted to show you different scenarios. So in reality, the correlation, because it's one single number, right? This is the only combination that is possible. This is the only minimum variance frontier that can be created for these two A and B, assuming the correlation between them is zero, and that is what is fixed. This is the combination, right? Now, because of this combination, what is happening? If a person wants to put 100% of his money, the minimum risk that he can think of is 21.22%, right? But what about a person who wants only 5% risk or a 10% risk? Right? What is the solution for those kind of people who want to invest in both A and B and at the same time have overall only 10% risk? Right? Some options are actually getting moved out. That is where we bring in the next concept of combining a risk-free asset with a risky portfolio. This is a risky portfolio. Now I'll combine a risk-free asset to this. What does that mean to me? Now, in this what I'll do is, I'll choose one combination, one combination. Probably let's say I'm choosing 50-50 for simplicity. I'll choose this one combination. Like that everyone can choose different combination depending on their risk profile or something. We can choose one such combination. Now what I'll do is, I'll take two scenarios. One is risk free, the other is risky. Risk free and risky. What are the numbers for just like this itself? Let's say I'm taking risk free, I'm taking risky. What are the returns of the risk free? Let's assume whatever is the risk free rate of return, I'll assume some 10% is the risk free rate of return. What does that mean? Probably a government security. Whatever the return, probably an FD, where or not even a bank, probably a treasury bills, whatever the return that it is going to generate, I am typically calling it as a risk free. For simplicity, I am just taking some number as 10%. Whereas for a risky security, the return was 25%, because I am choosing this combination as a risky. Right? So the return is 25% for this. Similarly, the return for the risky security is 25%. The risk in case of risk free is 0, because it is risk free, 0 risk. Whereas the risk in case of the risky security is 23.58, and correlation will be 0 between risky and risk free, because whatever may be the changes in the risky, the risk is constant. The risk free is constant only, right? The risk free does not change at all. Even though the risky security is changing drastically, the risk-free does not change at all. That is why we are calling as risk-free. It does not change. It is fixed. So the correlation with anything else is zero itself. They are not related at all. Now, the same logic I can apply to this combo now. The same kind of a diagram. The same kind of situation. I can apply 0% in risk-free, 100% in risky, so on like that. Now, in this also I can talk about the return, the variance, and the standard deviation. All these three I can try out for this combination. The same formulas, right? W1, R1. R1 is risk-free here. W1, R1 plus W2, R2. This is the expected return. So the expected return is going anywhere from 10 to 25%. The variance, the same logic I can use. W1 squared the variance of the first one, right? W1 squared the variance of the first one plus W2 squared into the variance of the second one anyhow. I will not consider the remaining plus 2W and W2 covariance. Correlation is 0, so covariance will be 0, so I will not consider that term at all. So the overall variance of the portfolio is going to be this much. W1 squared, right? W1 squared the variance of the first plus W2 squared the variance of the second. So this is what is the overall variance, and I can find out the standard deviation, which is the square root of the variance. Square root of the variance. This is the standard deviation. So obviously these are the numbers. Now you see, if I try drawing a similar kind of minimum variance frontier curve. How did I draw that? I took the standard deviation on the x-axis and the expected returns on the y-axis. The same logic I will apply now for this newly generated. This newly generated, what it is, to a risky portfolio, whatever was there, I have added a risk-free asset. So what was my risky portfolio? 50-50 portfolio. So risky is 50-50. And now I have created something, let's say 70-30. 70 in risk-free, 30 in risky. Out of that 30 in risky, 50 in A, 50 in B. So overall it is like 15% in security A, 15% in security B, 70% in risk-free. That is what is the meaning. When I am saying adding a risk-free asset to a risky portfolio, I have taken some combination portfolio. To that, I am adding a risky asset, risk-free asset in some combination. So risk-free asset 70, the risk some combination. All these combinations I am trying out. So if this is the scenario, what does that mean? 70% of my total money I have put in risk-free. Probably a bank deposits or government securities kind of stuff. 30% of my money I gambled in the risky portfolio. And that 30% I have gambled in such a way it is 50-50 in both A and B. So it means overall 15% of my money I have put in A and another 15% of my money I have put in B. If that is the scenario, my risk is 7.07%. Overall risk. Overall risk is 7.07%. Overall return is 14.5%. Now, by adding a risk-free asset, we are catering to the needs of the people whose risk levels are much lesser also. See, we are giving a solution that you can still invest in A and B, though your overall risk-taking level is only 10%, you can still invest in A and B. Whereas in the earlier solution, when we were talking of only risky asset, no combination could give a risk of 10%. But here, we are able to generate the risk right from 0%. So, utilize A and B. You can still utilize the investment in A and B and create the risks of your choice altogether. Now, just let's try drawing this line. Right, I'll try drawing this curve. I'll try drawing this curve. So the standard deviation is taken on x-axis and the returns are taken on y-axis. You see there is no more curve, it's a straight line. So one simple logic, when a risk-free asset is added to a risky portfolio, the curve becomes a straight line. So it's as simple as saying, as the risk is increasing, the return also keeps increasing. So for a person who is interested only in 15% risk, you will choose this combination for him. What is this combination? Probably you are saying, whatever, 19%. What is that 19% combination? 40-60. So 40% of your money put in risk-free, 60% you put in risky. So risky means 50-50. So out of that 60%, 50%, which is 30% of the total, you put in security A, 30% you put in security B. So because for a risk-free asset, see, it's as good as seeing now you apply your variance formula, W1 squared sigma 1 squared, W2 squared sigma 2 squared is 0, because sigma 2, which is the risk-free, if I assume, so that is 0, the covariance part is 0. So all it is coming out is W1 squared sigma 1 squared. So because of that, if I take the square root, it is nothing but W1 sigma 1. Which is nothing but it's a linearly dependent. So you will always see a straight line only. Whenever you bring in a risk-free asset to any risky portfolio in any proportion, you will see a straight line itself. This particular straight line is called as the capital allocation line. You are allocating the capital across different layers of risk and return combinations. So capital allocation line is this straight line. Whenever you join a risk-free asset to a risky portfolio, whatever the resultant that comes out is what we are calling as the capital allocation line. Now, the point is, here you have chosen that 50-50. If you had chosen the 60-40 here, you would have got another line. Instead of 50-50, now you see, probably this is the line. So just for noting purpose, across this 50, you just note down some of the numbers. The return is 14.1, the risk is 14.19% and the return is 17.5%. If you had taken the 50-50 combination. Now probably instead of 50-50 combination, here I will take some other combination, let's say this, I'll take 80-20, doesn't matter. I'll take the 80-20 combination, so the return is that much, the risk is this much. right? Now you see, come down here. What about corresponding to 50-50 here? The overall risk is 12.49% and the overall return is 16%. So what is it that is coming out? There is another separate line that is coming out. The line is different. Earlier, for a 14.19%, you are seeing a 17.5 on the return. Now for a 12, for that same 50-50 combination, you are seeing a risk also lesser, the return is also lesser. So what is happening for that same 50-50 combination, you are finding different lines for, see, when you are choosing different layers of risk, different layers of returns are coming out. So basically, in short, instead of one single line like this, you are having multiple lines like this. You are having multiple lines. For each combination of the risky portfolio, you are having multiple lines coming up. Right? You are having multiple lines coming up. All of them starting at the risk-free rate of return itself. Because when the risk is zero, the return is constant, which is whatever we have mentioned as a risk-free rate of return. That is that number. But with the various risky portfolio combinations, what is coming out is your line slope is changing slightly. In some cases, it is very much steep. In some cases, it is very much flat. So, all those lines, whatever are possible for various combinations of risky securities, right? Different risky securities, risky portfolios can be combined with a risk-free. Like that, we have combined one, where we have taken 50-50. After that, we have changed it to some 80-20. We have got some other answers, right? So, what is that? In short, if I see these graphs, they are all different lines, all originating at the risk-free rate of return itself. From that same 10%, all of them will have different levels of slope. So each one is a separate capital allocation line. So in a particular scenario, well, correct. In the 70 in risk free, 30 in risky. But in that 30, probably I'm changing 70 of A and 30 of B, or 50 of A and 50 of B. Because of all these things, what happens? The line that comes out is the one that is either flat or steep. Multiple capital allocation lines are possible. Now, the simple logic is, what is this capital allocation line telling me? The higher the risk that you are taking, higher is the return that you are going to get. Right? Now look at it from a typical investor standpoint. If he is willing to take a risk of, let's say, 10%, right? There are so many returns that are available here because there are so many capital allocation lines. There are so many returns that are coming out. Now, why will he choose all these returns? He will always choose the maximum out of them. So, which means there is only one line out of all these possible capital allocation lines. There is only one line that is very efficient. See, what we are saying, first we started off with 50-50. When we 50-50 of the risky. I took 50-50 of the risky and the different combinations of risk-free and risky. This is the line we got. Which means for this much of risk, I will get this much of a return. Right? So now, if I change, okay, let's be clear here. for a 20% risk, will make things more easier from our understanding standpoint. For a approximately 20% risk, right? Where is my 20% risk? Okay, 19.98. For a 20% risk, I will get how much? 19.6% return in this example. Now let's say I change this to 50-50 combination, the risky. I change it to 50% combination. These are what are my numbers. Now you see for a 20% risk, how much is the return I can get? For a 20% risk, you see I am getting slightly more. Not 19.6, definitely. I am getting about 20. Correct? So probably let's see, for a 20% risk, I'm actually getting 20.5% return. Right? In that earlier combination, when the risky was 80-20, for a 20% risk, I was getting only 19.6% return. Now when the risky combination has changed to 50-50, for the same 20% risk, I am actually getting 20.5% return. Why will so these are two different capital allocation lines. Like that you change it, you will get something more. So all of them are starting from 10, from that risk free, but each one is having a separate slope. Each one is having a separate slope. Now what we are saying is, they are all different capital allocation lines. Fine with that? Now, what is that capital allocation line telling us on one side? As the risk is increasing, the return is also increasing. Correct? Because it's a straight line, it's no more a curve. If it is a curve, then probably there are two different points where the returns are increasing. These are all straight lines. So now here what is coming out? Because of different capital allocation lines, for one same value of risk, I am getting multiple returns on multiple capital allocation lines. Like for 20% risk, I am getting 19.6 as a return in one capital allocation line, 20.5% as a return in the other capital allocation line. Again, from an investor standpoint, he will choose the one that is having the best. So that is having the highest highest slope is what will be chosen. Right? But even that is coming through one combination of risk-free, one combination of risky itself. That highest line also has come with one combination of the risky scenario itself. That combination, that portfolio, what the system suggests is, what the theory suggests is, that is the only portfolio which every investor has to look out for. And that portfolio is called as a market portfolio. The whole market will be looking out for that portfolio itself, whichever the one that maximizes your, for this combination of securities, whichever the one that maximizes the return for each unit of risk that is being taken. So that is called as a market portfolio, and that particular CAL, capital allocation line, is actually called as a capital market line. That particular straight line, which is having the highest possible slope out of all CALs, which means CALs could be many in number, but CML is only one. That particular line which is having the highest possible return, which every investor obviously will look out for. That is what we are calling as a capital market line. In any of these things, now if it is the highest return, now return per unit of risk, what is that name which we have called earlier? Excess return per unit of risk. Sharpe ratio. the slope of the CML is nothing but the Sharpe ratio. Right? The slope is nothing but the y-axis difference divided by the x-axis difference. That is what is the definition of the slope. Y-axis is what? The return on your portfolio minus the risk-free. If you look at the graph here, this is, let's say, the return on the portfolio. This is the risk-free. So this is RP minus RF, and this is nothing but the standard deviation of the portfolio. So slope is nothing but the y difference by x difference. Difference on the y-axis divided by the difference on the x-axis. So RP minus RF divided by sigma p, which is nothing but our definition of the Sharpe ratio itself. So the linkage is the slope of the CML line is nothing but your Sharpe ratio itself. Right? And of course, on the y-axis, it will intersect at the risk-free rate of return. The CML curve, some of the things which we may have to be comfortable with. The CML curve cuts the y-axis at risk-free rate of return. Right? The slope of the CML is nothing but your Sharpe ratio. So, in some case, okay, this is the return. It's even also called as your characteristic line. The return on the security. If you are taking the returns only, okay, if I take the standard deviations of, standard deviation on the x-axis and the returns on the y-axis, we got the CML. We got the CML as the standard deviation of the portfolio is taken on the x-axis and the returns of the portfolio are taken on the y-axis, with a risk-free asset also being included. Now, if I take a line, another line between, okay, I'll cover this slightly later. Between when we talk about SML, I'll come there. So just hold on to it for some time. Now, apart from whatever we have discussed, some of the things about the CML or CAL. CML is only one. Only one line will be there as a CML, and that is nothing but the line that is corresponding to the market portfolio. Market portfolio is nothing but most optimal kind of a portfolio, which it thinks that all investors are rational. All investors have full ample knowledge. So they will always, because that is the one that is giving the best possible combination, only that combination will be chosen. There is no other best combination above that. So that is what every risk-averse investor will typically choose. Because risk-averse investor, we said, he will choose the one, given there are two securities with the same level of risk, he will choose the one that is having the highest possible return. Right? So for him, that is the best choice. There is no other choice. Right? So that is where the CML is coming out as an interesting concept. So there is no more concept of diversification beyond that. It is already a fully diversified kind of a combination. Right? And so the portfolios, anything to the right of it, any CML outside. Okay, this is your CML line issue. If I want to create a portfolio to the right side of it, which means more risk, less return, they are not efficient for me. Anything above it, they are unattainable for this level of risk. I cannot attain that level of return. And it is also possible that the risk increases because I may end up, see, if I have to invest, let's say instead of 100, see, here we are talking only at the rate of 100% or something. But what about, let's say I create another scenario of 110 and minus 10. Even this is possible. How is this possible? I short B I short the risky asset. It's like borrowing. Whatever the proceeds that I am getting, using that I am buying A. No one is stopping me from doing that. Only under the assumption that unlimited short selling and all are not possible, we are giving this kind of a solution. But if those kind of combinations are possible, then some other combinations also will come in. But that can even increase my risk also, because there is a borrowing that is getting involved in that. So because of all these things, the scenarios could be slightly different also. In this again, one more major aspect that we have to understand is, out of this total risk, whichever we are talking of, standard deviation or the total risk, we always break it into two parts: the systematic risk and the unsystematic risk. See, out of that total risk, the breakage happens into the whole economy specific risk and the company specific risk. Some portion of the total risk is in the economy itself, is in the equity market itself, because even the GDP changes, right? From the expectations, even the GDP changes, even the interest rate changes, everything changes from expectation. So if a GDP changes, the whole market is impacted equally. It's not one company is impacted because of that, right? There is a big impact on the whole economy itself. So the risk, there is a fluctuation in the stock price. To some extent, I can attribute it to the fluctuation in the economy itself, to the fluctuation in the equity market as a whole itself, because equity markets generally are looked at as more risky compared to the bond markets. So some portion of the risk I can attribute it to the general and macroeconomic factors of the country. So that portion of the risk which can be attributed to the macroeconomic, to the part of the system itself, that particular risk which is a mandatory part of a system, we call it as systematic risk. So no diversification can reduce that risk, because even if you buy some other security, that risk is present in that security also, because it's present in the overall GDP, overall economy, overall equity market itself. That much of risk is present. So you cannot diversify that portion of the risk. That is what is being called as systematic risk, and whatever is the remaining portion is what we call as unsystematic risk of the company, which is company specific risk, right? Some fluctuations are there because of company specific, so the returns could be more or less or whatever because of that company specific risk that is involved. That company specific risk you can reduce through portfolio management. By diversification, you can reduce the company specific risk or the unsystematic risk, but you cannot reduce the systematic risk at all. So there will be a definitely, so which means you cannot make an overall risk of zero as long as you are operating in the same market. As long as you are operating in the same equity market, because overall there is some risk associated with the equity market. Systematic risk is existing. So that portion of the risk cannot be diversified. Only the non-systematic risk, which is associated more and more with one single company or one single industry, you can diversify it by investing in some other company or some other industry. By creating a portfolio, you can reduce the overall risk, but it can be reduced only to a certain extent, to the extent of systematic risk. It cannot be brought below that extent of systematic risk by doing any kind of a combination. That's where sometimes people also say, see, sometimes there is a notion that I add more and more securities to the portfolio, it will keep reducing my risk again and again and again. But as it is saying, it cannot come down below a certain point. So probably after you add some 20 securities or 30 securities to the max, the overall risk cannot come below that point. So adding more securities is increasing your transaction cost, nothing more than that. Right? Because every buy sell you are doing, your transaction costs are higher. So it is increasing your transaction cost, but it is never reducing your risk or return. No compromise on the risk, because risk cannot go to zero. There is some risk that is inherent in the system, which is called as a systematic risk. And that systematic risk is measured through a tool called beta. Systematic risk, the presence of the systematic risk is measured through this tool called beta. But yeah, couple of more points we need to understand here. Unsystematic risk you can easily remove by doing an appropriate portfolio. So there is no cost involved in with it. So which means if you don't remove that unsystematic risk and you are taking that unsystematic risk, you may not get any better gains also out of it. So it's better that you eliminate the unsystematic risk altogether, because there is no advantage of taking that unsystematic risk also. Right? Now, this is where I can link it with that characteristic line. So here we are talking about, now how do I predict my returns? What are the mechanisms that are available to predict my returns? For that, we actually use a model development process. What do we do here? We know that the returns on a particular security could be because of some macroeconomic factors, could be because of company specific financial factors. Fundamental factors are more like sales growth, right, profit growth, which are probably the debt to equity ratio, some kind of performance ratios of the company. I may say that the profit or the returns on any investment on the stock price, the return on the stock price could be a factor of macroeconomic, could be dependent on fundamental, or could be some statistical related factors also. Now, if I try to build relationship between the return and these factors, some equation between the two, return equal to something times this, something times this, some kind of an equation like this, if I am building up, that is what we call as a return generating model, right? Some common, so in that I can use a single factor, which is probably only one macroeconomic factor or only one fundamental factor. Any one factor, only one input I use to generate a return, I call it as a single factor model. Multiple inputs I use, I call it as a multi-factor model. And the most common model is this one. The return on RI is the return on security. RM is the return on the market. Basically, it's a relationship between securities returns and the market return. Market is nothing but index, Sensex or Nifty. The equation that is built between the security returns RI and the market returns RM. So on a day I will take, on let's say for the last 1 year I have taken the stocks return, daily return of the stock, the daily returns of the Sensex. I build some formula between the two. That formula which I am building is what we are calling as a return generating model itself. Because in this, the input is the Sensex return. The output is the return on the security. Such kind, which is nothing but it's a graph again, where the return on the market is taken on one axis and return on the securities is taken as another axis, and again a line kind of a thing is typically drawn. That line is what we call as the characteristic line. If you see in the earlier slide which I left out, the line which is coming out between the return on the market and returns of the security, both sides it's returns only. In our CML, we had risk on the x-axis and return on the y-axis for the portfolio. Here we are talking of return on the security on the x-axis, return on the market as y-axis, or return on market as x-axis and return on security on the y-axis. So security returns are always on the y-axis, whether it is for your CML or the security returns are on the y-axis. X-axis we had the risk of the portfolio in case of CML. The return on the market, I am taking it in the characteristic line. So this particular line is what we call as characteristic line. The slope of this line is what is called as beta. So the slope of the characteristic line is beta. The slope of the CML is Sharpe ratio, right? Definition wise, beta is defined like this. Covariance between the security returns and the market returns divided by the variance of the market return, right? So this is the definition of beta, and by default for the market it is 1, or the average value of the beta is equal to 1. So any beta which is less than 1, any security or a portfolio, if its beta is less than 1, we call it as less riskier than the market. Greater than 1, we call it as more riskier than the market, right? We call it as more riskier than the market. Any beta greater than 1, we call it more riskier, because the it has more systematic risk, more riskier than the market. And if the beta comes to 0, then it is nowhere correlated with the market at all, right? Because beta is nothing but it is computed from covariance divided by variance, and if the correlation is 0, covariance will be 0. So you can easily say if the beta is 0, means correlation is very much 0, so nowhere related with the market. So that is one. Now the most important thing as a part of our return generating process is called as the capital asset pricing model. Okay, the simple logic for us. Let's assume, let's try to draw a simple line, a simple graph, taking a risk on the x-axis. Let's try to draw a simple line taking a risk on the x-axis and return on the y-axis. But risk this time, I will take beta. I will not take the total risk. I will only take the systematic risk. Systematic risk is beta. So I will take the systematic risk on the x-axis and the return of the security on the y-axis. Because it's a risk return kind of a graph, and where there is a risk-free asset also existing, your line will be more or less a similar kind of a straight line. So this is nothing but your risk-free rate of return, right? Now let me assume that this is the market. For the market we said beta equal to 1, right? For the market the beta equal to 1. So corresponding to this beta, let's say this is the market return. Possible? This is the market return. Market the beta equal to 1. So this is the market return. Now what is the slope of this line? RM minus RF. The x-axis, the y-axis difference is RM minus RF by 1. Beta is 1. Right? The gap on the x-axis is gap between 0 and 1, which is 1. So RM minus RF, which is what? Risk premium. The actual return on the market minus the risk-free rate of return, which is nothing but the premium which the market has generated over the risk-free rate of return, right? So probably I'll take this one value as RM minus RF. So let me assume some other security, not the market, some other security whose beta is either less than 1 or greater than 1. Some other security or a portfolio whose beta is either less than 1 or greater than 1. I'll call it as beta. Whatever is its number, 0.5 or 1.5, I'll call it as beta. So this is the return for that security which is having a systematic risk equal to this much. This is the return that it can generate. Probably I'll call it as RI. RI is the name of the return of the particular security. Now what is the slope of the same line? If I take from this dimension, it is RI minus RF, the y-axis difference, RI minus RF. The corresponding x-axis difference is beta. Between 0 to beta, the corresponding x-axis difference is beta. So even this is the slope. Even this is also the slope for the same line, for the same straight line. These are the two slopes which are coming out from two different ways, right? Now, because it's the slope of the same line, I can equate these two. Now, a simple arithmetic, Ri minus Rf is equal to beta times Rm minus Rf. Is it fine? So from here I get Ri equal to Rf plus beta times Rm minus Rf. Right? This is the most classic equation in the entire world of portfolio management or investment strategies, which is saying the return on a security, the expected return on a security is equal to the risk-free rate of return plus whatever is the excess risk. Beta is a measure of systematic risk. Whatever is the risk multiplied by its risk premium. That is what is the formula for the rate of return on a particular security. Now you look at expected return on a particular security minus RF equal to beta times RM minus RF. The two slopes. I mean, it's the same slope measured by two mechanisms. See, one I have taken beta equal to 1. If beta equal to 1, because it's a market risk, beta equal to 1 means it's the same as market. So the return also should be same as the market return, which I have taken as RM. So then taking the slope of that line, RM minus RF is on the y-axis, 1 is on the x-axis. So the slope is RM minus RF. Now the same thing, I have taken some other security whose beta is beta, either less than 1 or greater than 1. So its return should be some RI. The line is same for both. So because the line is same, slope should be the same. So I have equated the slopes of both of them. This equation came up. This is the most classic equation in the total risk return equation modeling. And this line, this particular line where I plot beta on x-axis. So you see, in this chapter we came across 3 lines. All 3 of them have the returns on the y-axis. Return of that security or the portfolio is on the y-axis. Risk of the portfolio on x-axis, CML, CAL or CML. CML being the most optimum out of all CAL. Risk on the x-axis, CML. The return of the market on the x-axis, characteristic line, which will, right, the characteristic line, and beta on the x-axis, it is called as security market line, SML. So if I take total risk on the x-axis, it is CML. If I take only the market risk or systematic risk on the x-axis, it is called as SML. security market line. Right? All these play a same role. Right? Risk versus return. The higher the systematic risk, the higher should be the return. The lower the systematic risk, the lower should be the return, and vice versa. Now, slope. Slope of the CML is the Sharpe ratio. Slope of the characteristic line is the beta. Slope of SML is actually one of these two. Both are slopes of SML only. This is one slope. This is the other way you are defining the slope. So this is nothing but risk premium. This is nothing but a trainer ratio. Trainer ratio. The slope of the SML is, there are two ways of defining the slope of SML. Either the trainer ratio when you take it like this, or risk premium when you take it as RM minus RF. Right? So this combination is what you have to typically remember. And of course, they have given some assumptions, and this particular equation is called as capital asset pricing model. Because asset pricing, you are determining the return on the asset. You are determining the return on the asset using the return on the market. Right? That is why this model is called as CAPM, capital asset pricing model. And the graphical line of that CAPM is called as SML. The graphical representation of the CAPM is what we call as SML. And apart from the concept and all, some basic theory that some basic assumptions that come into picture here. The CAPM, whatever this formula that has come out, is subjected to so many unrealistic assumptions. That's where today it is challenged very heavily in the market, though it's a Nobel Prize model. It was a Nobel Prize winning model in early 70s. But because of the assumptions it has made, today there are lots and lots of challenges that are going on that model. So you see some of the assumptions which probably look far from reality. It assumes that the formula that has come out, internally whatever the mathematics that has been used to arrive at that formula, somewhere or the other it has used all these assumptions. It has used investors are risk averse, which we have been discussing right from the beginning. They are rational, which is a very weird assumption. 90% of the investors will be irrational. So it is away from reality. Markets are frictionless. They don't have taxes, they don't have transaction costs, because there is nowhere in that formula they have talked about the taxes or transaction costs. Assuming there are no taxes and transaction costs, that is the formula. So that's a huge challenge. At least to some extent, I can go ahead. Probably what people generally do is they find out the return through that and do a plus or minus 1%, 2% to adjust the other stuff. Right? So it's some base to start with. And all investors have the same time period. You invest for 10 years, I invest for 10 days. But it is assuming that the investment period is same for all of them. They have the same expectations of the returns. All of them find returns, variance, covariance. They all do mathematical formulas and find out all these calculations. That's what is the assumption. And it says investments are infinitely divisible. A person, if he wants, he can buy 0.01 shares also, which is in reality not possible. So, because they did not take the integer, these kind of things into consideration, so they have to go as a part of the assumption. And prices are unaffected by the investor's trades. Whatever is the buying or selling I do, one single person cannot influence the price. But today, one big bulk purchase I do, the price mounts up like anything. One big selling, one single investor does, it can bring down the price also. So, but it has assumed that one single person cannot influence the price that heavily. So, based on all these assumptions that came out, but because they are assumptions, so today each assumption is getting challenged in a bigger manner. In your next level, you will even see what is the impact if this assumption is challenged. If this assumption is challenged, what could be the typical change in the formula if each of these assumptions is not holding true. But here our scenario is to just go ahead with, okay, these are the assumptions that are there as a part of the model, and going ahead with those assumptions. So typically, when we look at the Sharpe, the CAPM or SML, we have seen already Sharpe ratio, we have seen with respect to CML. The slope of the CML is the Sharpe ratio. The higher, the better it is. The slope of the SML is the trainer ratio. Same, because the scenario is same. Return is in the top, risk is in the denominator. Risk, instead of total risk, it is having only the systematic risk or the beta in the denominator. So the higher is the ratio, the better it is. There are two definitions here which will measure the performance of the portfolios. Sharpe ratio measures the performance of the portfolio, the higher the better. Trainer ratio measures the performance of the portfolio, the higher the better. Then there is one more called Jensen's alpha, which is also a measure of the performance portfolio. Now if you see, this is nothing but CAPM return. This is CAPM return. RF plus beta times RM minus RF. The actual return minus expected return. RP is the actual portfolio return minus what is expected based on the risk return profile. Actual return minus expected return. If that is positive, it means the security has performed, our portfolio has performed well. If it is negative, the portfolio performed below the expectations. Another way of measuring the performance of the portfolio. And there is one more model called the M squared. It's simply, see, we have the Sharpe ratio. So Sharpe ratio actually takes the return on the the standard deviation of the portfolio. Let's say return of portfolio minus risk-free rate of return divided by the standard deviation of portfolio. This is what the Sharpe is taking. Now what it is saying is, you adjust this to the market portfolio, which means you multiply this by the standard deviation of the market, which means you are adjusting the portfolio to the market portfolio by multiplying the standard deviation, the Sharpe ratio, with the standard deviation of the market. And so now it is as good as a market portfolio, because you have multiplied it with the standard deviation of the market. This becomes as good as a market portfolio. Now what it says is, find out actually what is the return the market portfolio has given. This is like the portfolio in terms of market. Your portfolio in terms of market, what is the excess return here it has given, versus the actual market portfolio itself. There are two things which we are taking. Your portfolio in terms of market, what is the return? Let's say your portfolio has given 10% return, but for a 8% risk. I'm giving you a simple example. 10% excess return for a 8% risk, right? But let's say the market risk is only 5%. So what is that I am saying? If for 8% risk, this is the excess return. For 8% risk, if 10% is the excess return. For a 5% risk, what is the equivalent excess return? Let's say 6% or 6 point. Let's say your portfolio has generated 10% return. For for risk-free rate, let's say it is 2%, and the risk of your portfolio is 8%. Now, when your portfolio is having a risk of 8%, it has generated an excess return of 8%. But market is the index, Sensex. Sensex is having a risk of only 5%. So if Sensex is having a 5%, now equivalently what is the return of your portfolio? 5%. So 5% is the actual excess return of your portfolio when you express it in terms of the market. That is one. So this is the return which your portfolio has generated, 5%, not 8%. 5% excess return is what is the return your portfolio has generated. Now you really see what was the return. The Sensex has generated above the risk-free rate. Now if I really see the Sensex data, let's say it has generated 6% return. Risk-free is 2%. So 4% is in reality the Sensex has generated over the risk-free rate. Your portfolio in terms of the market has generated 5% excess. So that 1% excess is what we are calling as M squared. Again, if M squared is positive and high, it's an indicator that your portfolio has done a much better job. If your M squared is negative or lower, your security, your portfolio has not performed to the expectation. So these are the 4 different ways in which people use these concepts to measure the effectiveness of the portfolios also. Right?